What's going on, guys? Bryant here. Today is Sunday, May 5th, 2024. Just a few days ago, we had the most recent FOMC announcement in which we were presented with a great trading opportunity. The FOMC announcements are scheduled almost every month throughout the year, so you can look them up on the government calendar and you can actually see and prepare for them in advance. What made this FOMC announcement something that was very special was the fact that it was volatile during the session, but as the market closed, price actually ended up landing right pretty much where it opened. So we can see here, this is a daily time frame on the SPY. We will jump into the intraday time frame in a second. The trade in which I took was referred to as a strangle. Now, if you don't know the name or the terminology for this type of strategy, just know it is made up by buying a call and a put. You can trade this on a cash account, on a margin account. You can trade this on any symbol that has options. So it's a very versatile strategy to have in your toolkit. I will address why I ran this in the futures, but this video is not necessarily about the specific trade in which I took. I'm just using it as an example because you could have taken this on the SPY, on the SPX. You can even consider a straddle, which is just buying the same strike prices. In this case here, I chose to use an out the money call and an out the money put. Any type of straddle or strangle would have worked. Now, if we jump back to the chart and let's go to an intraday time frame, this is the intraday price right here. So this was the day of the FOMC, which was Wednesday. The news hits the wire at 2 p.m. Eastern time. We can see there was an initial reaction, and then there was another reaction, and then the market essentially closed right here. Now, these levels that are on my chart are just some levels that I map out at the start of the week. If you've been following this channel for a while, you know that I use gamma exposure. Gamma exposure is one of the most significant edges that I find in my style of trading. But regardless of how you identify your levels, just know that these levels came from right here at the start of the week. I believe this was on the Monday, so 10, 12, so about 40 something minutes or so after the market opened. I like to plot my levels out and then I leave them up for the duration of the week. These are just levels in which I'm aware of where there's high negative gamma exposure, where there's high positive gamma exposure, where there's a lot of absolute gamma. If this is your first time seeing this, just search on YouTube or on this specific YouTube channel. I have a bunch of videos for gamma exposure and I have a playlist down in the description in which you can see how I'm drawing these levels. Regardless of what you use to draw your levels, everyone is aware of the 500 level for the S&P 500. It's pretty self-explanatory. It's pretty significant. It is a psychological level. It is a whole number. It's the S&P 500, so it's 500. There's all sorts of reasons as to why you should have the 500 level marked off on your chart, or at least be aware of it. This is just letting me know it was the highest negative gamma exposure for the week. It had the highest amounts of open interest combined for calls and puts. It also had the highest amount of put open interest, and that's what these acronyms are standing for right here. Again, if you're not aware of all that, I'm pretty sure you have 500 marked off on your chart. We can see it here for just from an intraday perspective. There was a lot of support that was coming in to the 500 level. The longer you do something or the longer you practice something, you should become better and better at what you're doing. However, there's also a phenomenon that happens whenever you're learning. Initially, when you first start off learning, you experience some sort of luck, and then you think you understand or you have a good grasp of what's happening, and then you have a little bit of a drawdown and this is usually where most people will doubt their skill, and this is where you start seeking information or knowledge, and then the more and more knowledge you obtain, you think it will make you better and better. However, there is this phenomenon that just because you're acquiring more knowledge, you actually don't become better at what you do, so then you end up doubting if it's even worth continuing. You find yourself getting a little bit worse, and this right here is just a loose diagram that I just drawn on the chart representing the learning curve, as well as there's a correlation between how much we learn and our experience and our skill set. Now, what happens with a lot of traders is we try to go through a phase in which we have a little bit of luck, then we have a drawdown, and then we try to learn a lot, and then we still experience a little bit of our drawdown in our trading, and sometimes we will doubt what we're doing, and then you'll experience some sort of a little bit of a burst here, and then everyone's P&L curve as they learn to trade is different. But for the most part, there is a time where most of us will try to absorb as much information or knowledge as possible. The problem is when you're doing that and you're also simultaneously trying to apply that knowledge in real time and trade, it becomes difficult because you have so much information floating around your head. And then eventually you start throwing out or weeding out the information that it's not actually helping you become a better trader, and you try to reduce all the information you know. And it's at this point where most people, depending on your field, whatever you're doing, if it's an area of expertise that requires some sort of skill, you start realizing that the better and better you get at something, it's less you actually have to think about what you're doing, and it becomes a little bit instinctual, or you just learn to rely or trust yourself. This is lately what I've just been calling a little bit of common sense. Now, obviously, common sense is not something that's going to be common or understandable to a person that's new to trading. So that's why I'm just sharing this sort of prerequisite or this explanation behind understanding every trader is at a different point in their career. If you're in this phase right here in which you just started and you're still learning, a person that's trading for this amount of time, and let's just say each of these points here on this graph is a few years, the person that's in year 4 or 5 or so of their trading, and compared to a person that's in year 1 or 2 of their trading, you're obviously going to be absorbing so much more information during this phase that can be actually more confusing to a person at this phase. It's just easy to understand. To make that even easier, let's take, for example, if you're an athlete and you are training to run a sprint and you're learning how to run a 100-meter dash with hurdles. When you first start out and you have a coach, there's all sorts of techniques and drills you have to learn. Some people take 3 steps in between hurdles. Some people like to alternate their legs in which they jump over the hurdles. And when you're training and you're practicing throughout the week before your track meet, you're literally counting your steps. 1, 2, 3, jump, 1, 2, 3, jump, 1, 2, 3, jump. And sometimes, again, you might be alternating your steps. Some people have a shorter stride. Some people have a longer stride. There's all sorts of different drills and methods that you have to go through. But once you get to the Olympic level, or you get to any type of high form competitive level, and you're racing maybe in a D1 collegiate school or something like that, you're not necessarily counting your steps on a conscious level in between each hurdle. You're just doing what you've been trained to do. The same thing if we take, for example, basketball. The NBA playoffs are happening right now, so I can't help but bring up a lot of sports references. But if you're training to become a better basketball shooter, you're going to have a coach and you're going to learn all these types of angles and what's better for you. How high should you extend your arm? How high should you jump? Should you keep your feet planted on the ground? Should you keep your elbow at a 90-degree angle? Do you want an obtuse angle? Do you want an acute angle? There's so many different things you're going to learn that obviously to a beginner, it's going to be very overwhelming. But somebody like Steph Curry, who's just taking his shot, he's not necessarily thinking about all that on a conscious level. The same thing can be applied to when you're trading. One person is going to be looking at, let me look at level 2. Let me look at time and sales. Let me look at what's going on with these candlesticks. Let me combine 500 indicators on my chart. Let's just keep micro analyzing all this stuff. And then there's another trader that can just glance at a chart, or maybe not even look at a chart and take a trade, and somehow it's profitable because they've put so much time in taking so many repetition shots or practicing or journaling so many trades, or maybe they have some sort of mentor or coach. So when the time comes, it might appear as if a trader is necessarily lucky. And a famous saying, if I remember correctly, according to luck is when opportunity meets preparation. So in this case here, this is the opportunity. And for one trader, it might seem as if they just got lucky. Now, yes, there is some sense of luck that's involved because no one knows what's going to happen exactly with price action or how the market is going to react to a specific catalyst. In this case here, all we can do is just make our best judgment call based on risk as a trader. As the SPY was holding up against the 500 level, it can be inferred, or we can imply, that there are people that are willing to keep buying at 500. This is what we're seeing or reading on our charts. So we can take the trade alongside these buyers, but at the same time, there's no guarantee that whatever news came out at 2 p.m. Eastern time, or whatever Powell was saying during the conference around this time, there was no guarantee to know 500 would hold. I'm mentioning this as part of the argument that it can be said I did get a little bit lucky, as I did trade the 500 call on the SPY. This was before the news actually came. We were talking a little bit about volatility or so, and I was just mentioning it is a corn flip. However, I was willing to trade the in-the-money 500 call for Friday. I didn't want to go out the money. I didn't know how high the market would go. I just wanted something for a person that trades mostly spreads, and I mostly like to capitalize on theta. It is sometimes hard for me to just buy a call or buy a put option, so I just wanted something that was in the money, that was a guarantee to make money. If the market popped and implied volatility decreased, I didn't want to deal with an out the money option not having a huge return, so I made it simple for myself and I just said, hey, 500 is holding. I'm just going to buy the 500 call. We all see what ended up with price action. We see how that played out. Ended up taking profits as we hit a key level, which was the max pain strike here and so forth. Now, this specific trade in which I took here is not the purpose of this video. I do want to address it because understanding what traders might be thinking before you actually enter your trade can also help you. So this ended up working out perfectly. The target, or the max target in which I would have been expecting from my 500 call, was 508 to 510. However, I was expecting that within a day or two, not within the same day. So I was happy to take my profit around 507 here, 506 and a half or so is when I took profit. And then I thought I was done trading for the day. I stepped away. I didn't really partake in any of this sell-off that happened during power hour. It wasn't until I came back during power hour and I mentioned this. I said, this would have been rough for anyone with an FOMC straddle. So again, remember, straddle is when you just buy an at-the-money call or an at-the-money put. So in this case here, anyone that did that is a worst case scenario for you to buy a straddle. So let's go back to the chart right here. And it's actually clear everything off of this chart. And there we go. So if you buy a straddle right before a news hits, or early in the morning here, anytime before this news hits, and you buy a straddle, that means you're buying a call and a put. So let's just say you buy the 501 call and the 501 put, or it could be the 500 call or the 500 puts. We'll just use 500 because it's the number in which we've been pointing out as a significant strike. So you buy a call and you buy a put because you have no idea which way the market's going to go. However, you're speculating that there is going to be some sort of a large move. There is a large move, but you decide not to take profit. And now into the close, price comes right back to where it was before the catalyst. This is a worst case scenario for anyone that purchased that 500 call and put. It is, in a sense, their max pain. It is the strike in which they're going to suffer the most losses if price does not move. Obviously, if you took a 0 DTE straddle and you did not take any profit here, you were completely crushed because as the market closed, it's expiring right at your max loss. However, from a common sense standpoint, we all know price, at least in this market, is too volatile to stay at one strike price for days on end. There will inevitably be some sort of large move, especially during earnings week. Apple still had earnings. On top of that, there were still other catalysts on the calendar for the week. So this becomes a golden opportunity right here. So this is where we actually close. So as I came back to the chart and I saw this, I mentioned that it was a worst case scenario for anyone that was in a straddle prior to the event. I had not seen this sell-off. So now I'm saying I'm planning to get a straddle or a strangle after 6 p.m. Eastern time when the futures market opens. The ES straddle seems smart right now that IV has cooled off. So in this case here, IV has decreased because now the catalyst has happened. So that means the price of the straddle is actually going to be cheaper than buying it before. I can imagine before the week is up, we will see another large move. Apple still has earnings too. It is a common sense trade idea. That common sense is not meant to make any other person feel bad that would not think about this. The reason I'm doing this video is just to bring some sort of awareness to this is common sense to an experienced trader. We are at 500. We've been at 500 a decent amount of time over the past few weeks. Now we're back at 500. We just had a catalyst. I've done a few videos before on the FOMC announcement. I haven't updated this in a while here, but we know whenever there is an FOMC announcement, we can expect some sort of move. This was back in 2023 is when I stopped marking this. So you can just jump back. You can pull up again the FOMC calendars in the past. Take a look at what price has done following FOMC announcements every time for the past few years. And then you can define what will be common sense to you. If we jump back to this intraday chart here, the reason this is common sense is because implied volatility has decreased. We are now back at a strike price that option sellers have sucked the most amount of premium out of the 0 DTE move. We have a couple major catalysts still on the schedule for the week. If I check right here off the top of my head, here we go. So here's the earnings calendar. We still have Apple on the calendar, which is the big one. Qualcomm I'm ignoring. It's Apple mostly was the large one. And what else did we still have on the calendar here for Friday? We would have still had some employment numbers, and this is just another view of it. So we still had a couple other major calendars here. So this is at the end of Wednesday. We had the jobless claims on Thursday. We have employment numbers. We have PMI coming out on the Friday. I'm not paying attention to what any of these catalysts are saying. I don't care. I'm a trader. I'm just trying to weigh risk reward. These are not long-term investment type of opportunities here. This is just saying, hey, in the next couple days, I'm expecting at least a 2% move. Now, if we jump to the straddle, I ended up trading the ES straddle again because I missed the trade during power hour. I walked away. I did not see this. I was not aware of what was going on. However, that is the advantage of having a futures account or being able to trade options on futures. It means after the market close, I can still enter in the same trade idea. And that's why I ended up grabbing this here at 6 p.m. as soon as the market. I simply could not wait to purchase the Strangle. This is it here. Just opened the 5DT Strangle as per my thoughts. So this is what it looked like at the time. And then the following day later, I think it was only up about 11% or so. So I decided to continue holding it as I was still expecting another 1% move. And if that happened, obviously the trade would have been looking pretty good. And that's actually what we ended up getting. So over a 60% return on the trade here. Again, my individual trade is not the point of this video. I'm just showing that as an example, as this is not something I'm speaking about rhetorically, or it's not retroactively. It is a live trade, again, which I took, but independent of my own personal trade here. The purpose of this video is what I hope you guys walk away from, and in the future be aware of something like this or this type of opportunity. This is an example here of if you were trading the straddle on the SPY, and I chose the Monday expiration when I opened it just because I didn't want to deal with weekly options. I wanted to give it at least until Monday in case it would have taken the full day on Friday for the move to manifest itself. I didn't want to have to deal with harsh time decay holding a strategy like this. But this is the example of the SPY. So in case you don't trade futures options, this is it here before the FOMC announcement. This is it here from the day after because there was another opportunity. As we can see, this trade is up over 100% or so if the person such as yourself decided to continue holding it. And this is just buying the 500 call and the 500 put. So nothing necessarily fancy. The reason I'm bringing it up on Thursday is because the markets gave another golden opportunity. So if you were hesitant here on the Wednesday and you were still doubting it, there was another opportunity here on the Thursday as price was still around 500. And this right here are opportunities you don't want to let go to waste because they're not very common, at least from recent memory for myself. Probably go back on the chart and actually just take a look at the previous FOMC announcements. Hopefully this video is shedding some sort of light on a simple strategy that you can use. It's one of the ones you can use even if you have a cash account. You don't need a margin account because even though a straddle and a strangle are technically considered spreads because you're purchasing them at the same time, you can trade these on a cash account because you're not selling to open any options. You're buying to open both of them. It allows for any account that is eligible to trade options. I believe even with a level 1 options account, you can partake in a strategy like this. And even a move such as this one, within the same day here was great. So from here to here, the net change on this day was almost 1%. So we were up 1% at one point during Thursday. And then the following day, we were up another 1%. So that 2% move from the initial open to its peak right here was 2.5% about. So as another little tip, when you're looking at these types of straddles here, this is an at the money one now, and this is for this upcoming Friday expirations. We can see right here, these are the break evens. Again, those will change throughout the duration of while you're holding the trade, depending on implied volatility. But at expiration, as long as price has gone past this, these trades will be profitable. You generally are not looking to hold them until expiration, although you can. This is letting us know right now that based on the current implied volatility, based on the current price of these options, this straddle is saying the expected move for this upcoming week here is essentially about a 1.2% up and a 1.2% down in the SPY. So that's just a little hack or a little tip for yourself to gauge some sort of an idea of, what is the options market pricing in for a move? Just another way to calculate an expected move. However, while you're holding these trades, you need to be aware of this is the worst case scenario is price is not moving, because if price is not going anywhere, this is where you can suffer from your max losses. That's going to eat up your profit and loss. And then implied volatility will also be decreasing because as price is consolidating, that's also going to usually lead to a drawdown in implied volatility unless there's some sort of catalyst on the horizon. Guys, hopefully this video exposed you to something in which you hadn't considered before in the past. If you enjoyed the video, like it, leave a comment down below. I'm planning to get back on YouTube a little bit more in the next few weeks, as I've been coding something very complicated and it's been draining a ton of brain power. Those of you in quant trading app obviously know what I'm talking about. But in the next few weeks, I'm planning on scaling back on the amount of coding in which I'm doing, and we'll be able to hopefully create more videos and get back to kind of what I was doing during December of last year, or at least November of last year. Thanks for watching, guys, and I'll catch you in the next one.